Right now, millions of people are following credit advice that's actually destroying their financial future. They're closing their oldest credit cards, paying off debt in the wrong order, and obsessively checking their credit scores. All because they believe myths that sound logical but are completely wrong. And here's the devastating part. These mistakes don't just cost you a few points. They can waste years of your life, keep you from buying a home, and lock you into paying thousands more in interest. If you've ever felt confused about how credit scores actually work, you're not alone. The system is deliberately confusing, and bad advice spreads faster than the truth. Today, I'm exposing 6 credit score myths that are probably costing you right now. Number 1. Closing old credit cards improves your score. This might be the most expensive myth on this list. People think having fewer credit cards makes them look more responsible to lenders. So they close old accounts they're not using, especially after they've paid them off. It feels like cleaning up your financial life, right? Wrong. This is one of the fastest ways to tank your credit score. And here's why. Your credit score is heavily influenced by 2 factors: credit utilization and credit history length. When you close a credit card, you immediately reduce your total available credit. Let's say you have 3 cards with a total credit limit of $15,000, and you're using $3,000. That's a 20% utilization rate, which is good. But close one card with a $5,000 limit, and suddenly you're using $3,000 out of $10,000. That's 30% utilization. You just dropped your score without spending a single dollar more. But it gets worse. 15% of your FICO score comes from the length of your credit history. Your oldest accounts are the foundation of this history. Close that credit card you got in college, and you're erasing years of positive payment history. Even if the account stays on your report for a while, you've stopped the clock on building that relationship with the creditor. Here's what to do instead. Keep those old cards open, even if you never use them. If you're worried about forgetting them and getting hit with fees, put a small recurring charge on them, maybe a streaming service, and set up autopay. The card stays active, your available credit stays high, and your credit history keeps growing. That unused credit card sitting in your drawer could be worth tens of thousands of dollars when you go to get a mortgage. Number 2, you need to carry a balance to build credit. This myth is costing people literal fortunes in interest payments. Somehow the idea spread that you need to carry a balance from month to month to show lenders you're using your credit. People actually avoid paying off their full balance because they think it helps their score. Let me be crystal clear. This is completely false, and it's exactly what credit card companies want you to believe. Your credit score doesn't care whether you pay interest. What matters is that you use the card and make on-time payments. You can charge something, pay it off in full before the due date, and get the exact same credit-building benefit without paying a penny in interest. In fact, carrying a balance can hurt you because it increases your credit utilization ratio. Here's how it actually works. Credit card companies report your balance to the credit bureaus once a month, usually on your statement closing date. As long as there's some activity showing up on that statement, even if it's just $20, you're building credit. Then you pay that entire statement balance before the due date. No interest, no wasted money, maximum credit score benefit. Think about what this myth costs. If you carry just a $1,000 balance at 18% interest, you're throwing away $180 a year for absolutely no benefit. Over 10 years, that's $1,800 down the drain, plus the opportunity cost of what that money could have earned if you'd invested it, all because of a myth. Number 3, checking your credit score hurts it. This myth keeps people in the dark about their own financial health. They're terrified to check their credit score because they've heard it causes damage. So they go months or even years without knowing where they stand, missing errors, missing fraud, and missing opportunities to improve. This fear is based on a misunderstanding of how credit inquiries work. There are 2 types of credit checks: hard inquiries and soft inquiries. A hard inquiry happens when you apply for credit, a mortgage, auto loan, or credit card. The lender needs to check your creditworthiness, and yes, this can ding your score by a few points temporarily. But here's the key. You checking your own credit is always a soft inquiry. It has 0 impact on your score. None. When you log into Credit Karma, when you check your credit through your bank's app, when you pull your free annual credit report, these are all soft inquiries. You can check your score every single day if you want. In fact, you should be monitoring your credit regularly to catch identity theft, billing errors, and accounts you didn't open. Not knowing your credit score is like not knowing your bank account balance. You're flying blind. You might think you're in great shape and get denied for a loan, or you might think you're in terrible shape and not even try when you actually qualify. Check your credit often, stay informed, make decisions based on data, not fear. Number 4, paying off collections removes them from your report. Here's a painful one. Someone has an old collection account on their credit report and they finally save up enough to pay it off. They think once they pay it, it disappears from their credit report and their score bounces back. They send the payment, feel relieved, and then check their credit a month later only to find the collection is still there and their score barely moved. What happened? Paying a collection doesn't erase it. It changes the status from unpaid to paid, but the collection account remains on your credit report for 7 years from the date of the original delinquency. And here's the cruel twist. With newer credit scoring models, a paid collection might help your score slightly. But with older models that many lenders still use, there's virtually no difference between a paid collection and an unpaid one. So what should you do? Before you pay a single dollar on a collection, negotiate. Contact the collection agency and request a pay-for-delete agreement in writing. This means they agree to remove the collection from your credit report entirely in exchange for payment. Not all agencies will agree to this, but many will, especially if you're paying in full. Get it in writing before you pay anything. Also, know your rights. If a collection is about to fall off your report naturally, say it's 6.5 years old, paying it might reset the clock on how long it stays visible. Verify the date of the original delinquency first. Sometimes the smartest move is to let an old collection age off naturally rather than paying it and keeping it visible longer. Number 5, you only have one credit score. People talk about my credit score like it's a single number that all lenders see. They check their score on one app, C720, and assume that's what the mortgage lender will see. Then they apply for a home loan and discover the lender sees 680. They feel lied to, but the truth is more complicated. You don't have one credit score, you have dozens. There are 3 major credit bureaus: Experian, Equifax, and TransUnion. Each one collects data independently and might have different information about you. One bureau might show a credit card you opened recently while another hasn't updated yet. These differences create different scores across bureaus, but it goes deeper. There are multiple scoring models. FICO has several versions: FICO 8, FICO 9, FICO 10, and industry-specific scores for auto loans and mortgages. VantageScore is another major model. Each weighs factors differently. Your FICO 8 might be 740, while your VantageScore is 710, and both are correct. Lenders choose which bureau and which scoring model to use. Most mortgage lenders use FICO scores from all 3 bureaus and take the middle number. Auto lenders might use a FICO auto score. The free score you get from your credit card app might be VantageScore or FICO 8, useful for monitoring trends but not necessarily what lenders see. The lesson? Don't obsess over the exact number on one app. Focus on the behaviors that improve all your scores. Pay on time, keep utilization low, maintain a long credit history, and have a good credit mix. The specific number matters less than the trend. If all your scores are moving upward, you're doing it right. Number 6, income affects your credit score. This myth causes 2 problems. High earners think they automatically have great credit, and low earners think they can't build good credit. Both are wrong. Your income is not a factor in calculating your credit score. Not at all. Your credit score is about how you manage debt, not how much money you make. You can earn $30,000 a year and have an 800 credit score if you pay your bills on time and keep your balances low. You can earn $300,000 a year and have a 550 credit score if you miss payments and max out your cards. The credit bureaus don't even know your income unless you report it on a credit application. Now, income definitely matters when you apply for credit. Lenders want to know you can afford the payments, so they'll ask about your income and calculate your debt-to-income ratio. But that's separate from your credit score. Your score gets you in the door by showing you're responsible with credit. Your income determines how much they'll lend you. This distinction is crucial because it means anyone, regardless of income, can build excellent credit. You don't need to wait for a raise or a better job. Start with a secured credit card if you have to. Make small purchases and pay them off. Build that payment history. Focus on what actually matters: payment history, credit utilization, length of history, credit mix, and new credit inquiries. Your credit score is too important to leave to guesswork and myths. It affects whether you get approved for a mortgage, what interest rate you pay on a car loan, whether you get that apartment you want, and even whether some employers will hire you. Every year you spend believing these myths is a year you could have been building a stronger financial foundation. Start today. Check your credit for free. Keep those old cards open. Pay your full balance every month and make decisions based on facts, not myths. Your future self will thank you.